Okay, so if you've got any savings or investments here in the Netherlands, listen up. The way you're taxed, it's about to get a major shakeup. The Dutch government is completely overhauling its wealth tax system, and, we're going to break down exactly what this means for your wallet.
All right, here's the bottom line. The government is basically saying, we're tired of taxing you on a fictional return, some number we just made up, and we want to start taxing you on what you actually make. I mean, this is a huge, huge shift, and it's all spelled out in a new bill that's making its way through Parliament right now.
But, to really get why this is such a big deal, we've got to take a quick step back and look at how things are set up right now. The whole Dutch income tax system, it's built around this concept they call the three boxes.
It's pretty straightforward, really. Think of it like this. Box 1, that's for your salary and your main home. Box 2 is for any, substantial business shares you own. And Box 3, that's the one we care about. That's where all your savings and investments are parked. And yep, you guessed it, it's Box 3 that's about to get a complete makeover.
So for years, the Dutch tax system has been, well, it's basically been guessing. They just kind of guessed how much your investments grew, and then they'd tax you on that guess, that deemed return, even if your investments didn't do that well at all. This new proposal, it just throws that whole idea right out the window. The new plan is to tax your actual returns, the real, tangible profit you've made. Makes sense, right?
Okay, so the big question is, how are they going to tax these actual returns? Well, the plan is to split Box 3 into two totally new categories, and each one has its own set of rules. We're talking about a capital growth tax on one side and a capital gains tax on the other. Let's dive in and see what that actually means.
All right, so this is the crucial difference. You really want to pay attention here. With the capital growth tax, you get taxed on how much your assets have gone up in value every single year, even if you haven't sold anything. We're talking about your unrealized gains, your paper profits. But then on the flip side, you have the capital gains tax. With that one, you only pay tax when you actually sell and lock in that profit, when you realize the gain. See the difference?
So what kind of stuff falls under this new capital growth tax? Well, it's pretty much all the usual suspects. We're talking shares, cryptocurrencies, even the money in your savings accounts and foreign currency balances. And what this means, and this is a biggie, is that you could get a tax bill at the end of the year just because your portfolio grew, even if you didn't touch it. Not one single share sold.
Now, over on the capital gains tax side of things, we're looking at different assets. This is for stuff like real estate. Think a rental property or a second home, and also certain kinds of startup investments. And remember, with this one, you only pay the tax when you sell. But here's another really important difference. You can actually deduct costs, things like loan interest or maintenance fees. You can't do that with the assets in the other category, so that's a pretty big deal. Okay, let's pivot for a second because there's one group of people who are really going to feel these changes, and that's expats. For years, as many of you will know, the 30% ruling has been this huge tax advantage. But that's all coming to an end, and the timing couldn't be more interesting because it's happening right as this new system is set to kick in.
So the way the 30% ruling used to work was pretty amazing for expats. It basically shielded all of your worldwide assets from Dutch taxes by treating you as a partial non-resident. Well, say goodbye to that. It's over. That exemption is being wiped off the books completely. And this is what people are calling the double whammy for expats. Just look at the timeline. First, that long-standing tax break, gone, as of January 1st, 2027. Then, boom, just 1 year later, this brand new, arguably more complex tax system is slated to kick in, and it's going to apply to all of their worldwide assets. It's a real 1-2 punch, and it's definitely going to have a major impact on a lot of people's finances.
Now hold on. Before you rush off and completely change your entire investment strategy, there's something really important to keep in mind. This is not a done deal, not even close. Right now, it's just a proposal, and it has a very long and very uncertain road ahead of it before it ever becomes law.
And it's not just us saying that. Even the experts are pretty skeptical. There's a genuine concern that this new bill, while trying to fix one problem, might actually create a whole bunch new ones. Like the quote says, the path forward here is, well, it's anything but clear.
So what's the journey for this bill look like? Well, first, it has to pass through the House of Representatives. They can approve it, they can reject it, or they can amend it. If, and that's a big if, it gets through there, it then heads to the Senate. And the Senate has the final say. They can either approve it or kill it. So you can see, it's a real legislative gauntlet, and there is absolutely no guarantee this proposal ever makes it to the finish line.
So this really brings us to the ultimate question, doesn't it? Is this new system going to create a fairer tax, or is it just going to be a more complex one? I mean, the goal, taxing what you actually earn, sounds great on paper, but will it just end up creating a mountain of extra headaches and paperwork for everyday investors? That is the core of the debate happening right now, and you can be sure the answer is going to have a very real impact on your wallet.